Thank you, everyone, for joining me today. My name is Kim. I am a financial wellness coach here at the New Hampshire Federal Credit Union Centers for Finance and Education. Today, we are going to be talking about getting your credit score home buying ready. This is a big subject for a lot of people, especially people that are starting to look for homes and they may not have started this process earlier and might have an issue right now with possibly getting financing. So that's what we're going to talk about. That's what we're going to really look at and get yourself ready to purchase a home, because you want to make sure that when you are financially ready, that all of a sudden you're not going to be shut down because of your credit score. Okay? So again, we are the Centers for Finance and Education. We like to bring education and coaching to individuals, families of the community, and help you guys implement the proper tools to reach your financial goals. So one of these is, the proper tools is, let's understand what the credit score is, what your credit report may look like, what we have to do to make sure that you can purchase that home. So let's go ahead, let's get started. Things to cover today. So we're going to be talking about the importance of credit. It's really good for you to understand how credit impacts purchasing a home. Okay, because if you have that understanding, the rest of it will come easier to you. Okay, what lenders look for. This is going to be something too, that if you know what they're looking for, you know what to pay attention to, you know what needs to be worked on. After we look at these first two subjects, we're going to look at how to clean up credit. So if you do your research and you find out that you don't have the best credit, which happens more often than not, how to clean it up, how to get it to a place where the lenders are going to be like, oh, this is going to be a great borrower, okay? And also, some people may have to build their credit. So it's not cleaning up. They just may not have enough stuff reporting on there, or may not have anything at all reporting on their credit report. So that's where we talk to people about how to actually build it. Okay? So let's continue. All right. Importance of credit. So obviously, one of the biggest things is your ability to actually get a loan. So if you have good credit, then you're more likely to be able to get financing to become a homeowner. If you have bad credit, you are more likely to get declined for a mortgage. Okay. Better rates. Rates are crazy when we're talking about mortgages, because when you think about 3% versus 6%, it doesn't seem like that big of a deal, because you're like, oh, that's only 3%. That's not nothing. Well, because a home is has such a high value to it, that small interest actually is a big deal. So I'll give you an example. When we were looking for a home, we were looking in the worst time ever. And at that point, the rates were down to, you think, a little above 2%. We could afford a $425,000 home. Okay? And we would have this certain payment. And that's what we could afford. We did our budget. That's what we could afford. So during that time, that's what we were looking at. But because of the market being the way that the market was, our offers were not getting accepted. And so it took us 2 years. We found a house, but at that time, the interest rates skyrocketed. So at the time we bought, the best of the rates was about 7%. And from that move, about 4.5%, we were no longer able to afford a $425,000 home. We were only able to afford a $300,000 home because of the interest. That's how it really impacts your buying power. And my husband and I both had 800 scores. So we got the best rate we possibly could at that time that we purchased. Now, might I have wanted to wait a little bit longer until rates possibly came down? Of course. But at the time, it was something where it was a necessity. We have a fast growing family, and so we needed to do something. But so rates can really affect your purchasing power. And the great thing about rates is even though we could not control the 7% that it went up to 7%, what we could control is that we got the best rate possible at that time that we were getting the mortgage. Because if we did not have the best credit score, our rate would have been even higher. So for instance, let's go ahead, let's look at a $300,000 home. And I'm just going to do a quick calculation here. We're going to say that we did 30% down, 10% down, which then brings that loan amount down to $270,000. And let's do the interest rate of 7. And let's say we're doing a 30-year fixed. All right. So that's going to go ahead. And let's calculate that. So that shows us and I didn't put in any additional information. So it shows us at a payment about $1,800 per month. Okay. Now, if we didn't have the best credit, the best possible score, that we maybe they added, let's say 4% onto that. So that would make the interest rate 11%. So let's see, we were at 1,800 at the 7%. Now let's see what we are at the 11%. 11% brings us up to 2,500. So just that hike of if I had good credit versus bad credit, what that could mean for you. Okay, so that is why it's so important to really have the best credit that you can have. That way, when you're ready financially to purchase a home, you get the best rate that you possibly can. Okay. And let's look at other positives. So if you have a good score, the better coverage you get on home insurance, but also PMI. And PMI is a term that is used. It is a type of insurance, but it's for the banks. So, for instance, if you don't put down 20% of a down payment and have 20% equity in a home, then you have to do PMI. In years past, PMI used to be a set amount. When I was looking, it's probably like 12, 13 years ago, I was just kind of, messing around and looking. PMI was like $250. So if I didn't put 20% down, it was $250 additional every month. And what that does is it protects the bank. So you're paying the bank's insurance on that mortgage. So if something happens, they have coverage. So if you stop making your payments, they're okay. But now they actually do it according to your credit score. So this is why it's really important to have a good score. We put 10% down on our home, and our PMI is $20 a month because of the score that we had. Okay. So that's something else that can save you a bunch of money too. And that's just based on your score, right? So that's why we always talk about how important it actually is, because a lot of people think that, oh, well, it's not that big of a deal if I get, if I don't have a good score. So next, what we're going to be looking at is what are lenders looking for. So this is going to be helpful because you don't want to be blindsided. Say you have worked maybe a year or two on really bulking up your savings account to be able to put like a good down payment down. And then you go to the lender and they pull your credit report and they look at these factors from your credit report and they go, "You're not ready. You can't do this." And then you've like, "Oh my God, these past 2 years that I was working on this, if I would have known about these other things, I could have worked on that as well." So some of these things that we definitely focus energy on. Credit score, we talked about the importance of the credit score and how that helps. Payment history. So this is how your payments are made on debt items that are showing up on your credit report. Okay? If you have a car loan, you want to make sure it's paid on time. If you have credit cards, you want to make sure that they're paid on time. Payment history is, and we'll talk about this, I believe, in the next slide. We'll have the breakdown of what actually makes up the credit score. Okay? Debt to income ratio. We have a slide on that as well because this goes a little bit more in depth. This is your ratio of how much money you have coming in versus how much money is going out to debt instruments that show up on your credit report. Okay. Collections. Collections are one of those things where people are so funny. That if they have collections, they're like, "I'm just going to wait and let them fall off. That way I don't have to pay them." Okay, that is definitely one option you can do. But that also means that you're probably not going to be able to purchase a house in that time frame. So if you don't plan on doing anything, then that's definitely a choice that you can make. But if you're looking to purchase in a year or two and you have collections that still have 5 years to go, then your best bet is just to take care of them, okay? Because those hurt. And they also hurt your score. So it's not just like they're there and you say, "Oh, well, they're there," and you can explain it away. It's still very detrimental to your score, which, if your score is down, can affect your ability to get a loan. But then, even if you can get a loan, it can really hurt your interest. So for those collections that you have on your account, you may tell yourself that you don't want to pay for them, but you're paying for them in other ways. Because just like when we looked at the house, if you have went from 7% to 11%, now you're spending $700 more a month for 30 years. That's a lot of money when you could have just paid off those collections, right? Can you imagine if you put $700 a month toward your collections, how fast that would be paid off? But in the long run, if you say, "No, I'm not going to do that," you're paying that for 30 years. Okay. That's the type of stuff that you want to make sure that you understand financially what you are doing. Okay. And then another thing is stability of residency and employment. A mortgage is a very large purchase, as you know. And so lenders really like to make sure that we have good employment, because this is a loan. It's not like a car loan where you might have for 5 years, or a personal loan that you might have for 3 years. This is a loan that you could have for 30 years. So they like to make sure that there's steady employment, which makes sense when you think about it. You don't want someone that's working it's not good if they see someone working for 6 months, then taking 4 months off, then working for 6 months. So, maybe working on having a steady income is something that, as long as we do that, and maybe a couple years of savings and putting things away and just getting it ready and making it look as best as it can for those lenders. Okay. So here is how the breakdown of your score actually works. And this is why I said paying your items on time is going to be hugely beneficial for you. Is because 35% of your FICO score that your score is payment history. And all that is if you paid on time or you didn't. Okay? And with the credit score, it follows a bunch of algorithms where they watch your credit and how much it goes up, how much it goes down, and what you do, and it has all these built-in algorithms, okay? Payment history. So if you pay something 30 days late, that's going to appear on your credit report that you paid 30 days late. And that has negative feedback on your score, so it affects you negatively on your score. But if you pay something 60 days late, 90 days late, that shows up too, because they'll usually have a 2 for 30 days, a 3 for 60, 4 for 90s, or every report. The three major reporting agents do it a little bit differently on what they do, but they keep track of how late you were, and each one, as you go up the scale of being late, impacts your score more heavily. Okay. So even though it's ouchy at 30 days late, it's really ouchy at 60 and extremely painful at 90. Okay. And then that's why collections are so hurtful to your score, is because collections show that you didn't pay it at all. So you can see where when you don't pay for something at all, and it's the biggest percentage of your score, why your score might not be the best. Okay? Next is 30% of the score is amount owed. How much do you owe to others versus what you bring in for yourself? Okay? And this is a big one, because I've seen so many people fall into the trap of the credit cards, and we're told to continually open up credit cards to help them with their credit score. But what happens is when they open up these credit cards and they don't understand how to use them, what happens is spending behavior takes over. They end up spending more than they ever anticipated on spending, and then they don't even realize that it's actually hurting them to use their credit cards. Credit cards are not meant to be income supplementers, okay? And so what happens is you should not be using more than 30% of your available amount on your card. So if you have $1,000 card, so you have, let's say, a credit card that has you have an available balance of $1,000. That's the cash limit of the card. Okay, you should not be using more than $300 on that card at any given time. Now, I had a member that says, I paid off every billing period, and so I don't know why my credit score is not going up. She had a $1,000 limit on her card. She was putting every single bill that she possibly could put on it, and it would come out to probably $800-900 every month. And then she would pay it off because she had that amount in her account because she budgeted. She had it. It's not like she was spending it on other things. It was things that she budgeted for. Well, when we looked at her credit report, whenever it reported, it was reporting at the highest time period that she had the highest balance. It wasn't reporting when her due date was or whenever she paid it. And therefore, whenever she racked it up, it reported at whenever she had the most on there. And so it was actually affecting her negatively, even though she paid it off every month. So what we decided is, because she wanted to keep using it because that's how she got her perks and her dollars and her, points and all that good jazz. So what we said was, okay, what I want you to look at is see where it is after each week and make sure that you're paying it off each week. And then that way, no matter when they report it to the credit reporting agency, you're not above that 30% threshold. So she started doing that, and sure enough, her score started to go up, because it was no longer reporting at the highest level. Okay. Length of credit history. This is about 15% of your score. So length of credit history is how long is your longest trade line open for. So some people will get a credit card when they're 16 or 18, and they open that up and just like to have that. That's fine. And so, but what happens is if you don't have anything reporting under your credit, say you buy your car in cash, say you pay everything in cash, and he's like, well, I've always had the money, so why get a credit card? Unfortunately, if you go to get a mortgage, what they really like to see is stuff reporting on your credit report, because that will show them how well of a borrower you are. If you say you're going to borrow this money, you pay it back. If you don't have anything reporting on there, they don't have anything to go by. And so usually your credit report will say something like insufficient credit history because you don't have anything on there. So we definitely want to try and make sure we have length of credit history. Now, how you might be wondering, well, credit cards haven't been around that long. Correct. So how were they looking at this before? Before they had what we called manual underwriters. So the manual underwriters would actually look back and look at income, look at your pay, and look at your spending, and do that manual look through. Okay. And that's how they could get away with not knowing with borrowing, because that really didn't become popular until the 70s. And even then, people had credit cards, but they weren't popular. They started getting popular more and more as the generations went on. So 80s, 90s, and now most people today are doing mostly everything by credit card. New credit. So this is 10% of your score. So this is something that if you have a lot of new credit all at once, it actually sends up red flags. And the new credit tag on accounts, you typically stay on the account for 2 years. And then that new credit tag will fall off that particular merchant on your credit report. And so that's why we never, especially if you're getting close to buying a house, you never want to have new credit listed on your credit report. And actually, when you're in the process of buying a home, never, ever, ever take out new credit. And the lender should tell you this. Your realtor should tell you this. And the reason being is because when you go in and you get a pre-approval, and then you go looking at homes, you have to remember that's just a pre-approval. So at that particular time before you're buying the house, that was, you got pre-approved on your financial status at that time, okay? If you find a house and you're going through the process and your purchase and sales get accepted and you're getting really excited and things, and you end up, this has really happened, went out and decided, oh my God, I'm going to go to a furniture company. I'm going to furnish my entire house. I'm going to get a loan and da 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 da, blah 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 blah. One of the people that came to us afterwards told us about this, and because they went out and did that, when they went for the closing, because of what the mortgage company will do, is they will verify all your financials again before you close on the loan. And because they saw all of a sudden she took on all this new debt, she no longer qualified for the purchase of that home. So she lost her dream home because she went out shopping for the home. Okay. So you want to make sure you don't do that. Types of credit. This just looks at whether you have installment loans and revolving loans. Installment loans are like personal loans and car loans, where you have a start date, you have an end date, and you have the same payment. Revolving loans are credit cards, so because you have a set amount and you can use it, pay it off, use it, pay it off, use it, pay it off. That's why they're called revolving. Okay, so those are the things that go into how your credit score is calculated from your credit report. Next, I wanted to talk about debt-to-income ratio, and we're talking about how this is a big one. So debt-to-income ratio, or what they call DTI, is where the lender looks at your minimum payments reporting on your credit reports versus your income and what the ratio looks like, okay? So this is a big deal for financial companies because there are regulations regarding this, and they all have their own processes on what they're willing to accept. I usually tell people not to have more than a 40% DTI. That is ideal. Some places allow you to have 43%, some places as much as 45%. But I really tell you, try and be as low as you can with the debt-to-income ratio. Okay, so this is how they kind of calculated it. So this is an example of someone who has a home loan. This is a mortgage. Okay, and this looks like credit cards. All their credit cards, they have a credit limit of $34,000, but they've only used about $2,500 of that, and their minimum payment is $55. So in total, their debts equal $2,459. And in my calculation, we went ahead and did as if it was a household that was bringing in about $7,000 a month. So what you would do is you take this monthly payment amount, so the $2,459, divide that by your income, which is $7,000, and you'd calculate it, and then that would give you your DTI. So, for instance, our DTI, when we started looking, we were still renting. So when we started looking, it was actually at 26%. We wanted to make it sure that we weren't overspending, and because last thing we wanted to do was buy a home and not be able to do anything, right? You don't want to be what they call house poor. And when we looked at getting the mortgage, and after we got our mortgage and we did our DTI after that, our DTI went up to 34%. So it's still under that ideal mark, which is a good indicator that you're not overextending yourself. Okay? Because we've seen that way too much lately where people have been just, oh, I qualify because I'm right there. Yeah, just because you qualify and they'll give you a mortgage doesn't mean you probably should have one. Okay? So this is why if you're able to work on your credit, if you have a lot of debt, so if you're hovering around 45%, you might want to pay some of that debt down, put some more money in savings, and have a better debt to income ratio when you're going to actually purchase the home, because then you'll have more available funds for the home, because I'm guaranteeing you're going to have to fix it up or do something. Okay? So let's say we're interested in purchasing a home. We looked at our credit report, which is the first one. You definitely want to review your credit report because we want to figure out, okay, are we in a good spot to move forward? So we look at our credit report. What does it say? And this is something that you guys can do. Annualcreditreport.com is a great place to go ahead and look at your credit reports, okay? And if you haven't done it recently, definitely recommend it because it's actually a way you can protect yourself against identity theft, okay, and fraud. Because you want to review your credit report and make sure everything that's reporting on there is actually you and not somebody else, okay? So review your credit report. If you notice that it says there's late payments, if you notice that it says there's collections, that's when we want to make a plan on, okay, let's work on this. Let's, start seeing what we need to do, right? So we're going to clean it up. That's what we mean about cleaning up, especially with those collections. That would be, especially depending on how soon you want to purchase a home, we definitely want to look at getting those paid off. And because what will happen is, even though you pay them off, they will still be on your credit report, but it will say paid in full, okay, or settled, okay, which, even though collections are bad, it's still a good thing to see, the lender sees, that you went back and you ended up taking care of it, because we all know that life throws curveballs quite often. But if they see that you're actually trying to pay your obligations, that goes a long way. Okay. Next, late payments. Do you have late payments? It happens. What we say is just work on paying everything on time going forward. Okay. And what's really going to help you do that is a spending plan, or I like to call budget. That helps you understand what bills are coming out every month, but also you use what we call an allocated spending plan, which shows you when your check is coming in and what that check is covering. And people who may have had late payments but are making plenty of money, usually what happens is all the bills are coming out around the same time. And they just didn't realize it until they see it in picture form. And they're like, well, no wonder we're having late fees, or we can't pay this, or it's going, something's happening and we're getting all these fees. And so having a budget will definitely help. And sometimes people feel like they don't make enough, but they actually do. And when we look at the budget, we realize that it's just, there's some spending that is just going on that they just didn't realize was that bad, which happens. Okay. So also having an installment loan and also having a revolving loan can help increase your score. So having one of each. So we talked about that being a small part of your score, but still, like, especially if you only have a credit card, there is a loan that I think it's in a couple of slides, a credit builder loan that we usually recommend to help be an installment loan for you. Okay. And if you just have a installment loan, maybe having a credit card, applying for a credit card, and using that for necessities. Some people, especially if they really hate credit cards and don't want to fall victim, will get it and just use it for gas, something like that. Okay, so that's something that you can definitely do. And yeah, so those are the things that help clean up credit. And then with the budget, this I love a good budget. I've been budgeting since oh God, let's see. It's been about 12 years now that I've been budgeting. My husband and I had $90,000 in debt. By budgeting, we were able to pay that off in 5 years. We have been able to pay for our last 3 vehicles in cash. And we were able to pay for our wedding in cash, our honeymoon in cash, all by using the practices of budgeting and planning. And we were able to put 10% down on our home. And yeah, so we are, I'm very fond of a budget. I think it's an amazing tool. And I think if people give it a try, that they will find out that it's actually very freeing. A lot of people think it's going to be restrictive. It is not. If anything, it actually removes financial stress because you actually have a plan. Every month there's a plan. And you know exactly when things are coming out. You know exactly how much you're making. And it's extremely helpful. And it's definitely the tool that you're going to need if you need to improve your credit. Okay. Because you need to focus on what we're doing if we're paying collections. Okay, well, where is that money coming from that you're paying for collections? We might have to figure out and write down in the budget and say, well, each month I can throw $200 into a savings account that's set for collections. And if you owe $1,000 on a collection, you wait till that account gets up to $1,000. You call the collection agency and you say, "Hi, I know I owe you this money, and I apologize. But I have been. I do want to pay you. I was wondering if you were willing to settle on a lower amount than 1,000. And I can see if I can get that." And they'll say yes or no, and sometimes they'll say yes, and they'll say, "Yeah, we'll take 700." Well, that's great because you saved up 1,000, but now it's only going to cost you 700. So then you pay them and you go from there. That's how the budget helps, is really helping you stay a course to reach your financial goals. And this financial goal ultimately is to get you to be able to purchase a home. Okay. And I love this quote, having a goal without a plan is just a dream. So until you actually put that plan in place, which is the budget, that's going to be the plan to get you to where you need to go to reach your goal. Okay? All right, how to build credit. So there's a couple of things with building credit. So we've had some people that just had no credit history, and then we've had some people that just have had horrible credit history that it's no longer considered cleaning it up. It's just, let's just start from the bottom. So best ways to build credit. So if you don't have credit, or you might have one or two things and it's not really doing much, the credit builder loan. I absolutely love the credit builder loan, and we'll talk about that in the next slide. Prepaid credit cards. These are helpful because even though you still pay an interest on the card. Prepaid, it's called a secured credit card, where say you have $200, you give them $200 as collateral, and so they give you a $200 limit. So you can use that card, and you still make payments on that card because that $200 that you originally gave them is the collateral that's held to the side. And so if you ever rack up the $200 and then you don't pay them, they have the $200 to pay for that card. So they're not really out money. Okay. But that can help your score. Being an authorized signer on a family member's or a friend's card. Now, most people don't know about this, and it's probably one of the easiest things. So, for instance, when I was younger, I was able to be an authorized signer on my parents' cards. Now, that means that if they wanted me to have a card, they most certainly could give me a card because I was an authorized signer. But they didn't. And I had no access to their funds at all. But what's great is, as they're using their card and then they're paying their card on time, and they're doing this over and over again, it reports on my credit report because I'm an authorized signer. So we report that the card's being used, the card's getting paid on time. So you want to do this with somebody that you definitely know that they're good with their finances. You don't want to do this with someone who's not good with their finances. But the great thing about being an authorized signer is you're not actually responsible for the debt. Okay. So being a co-signer or joint on something, that's a little bit different, right? That means you're on that account. You're responsible for that as much as the primary is. And if they don't pay it, then they're going to come after you for the payment. That's not the case being an authorized signer. And getting a credit card can help. I usually say don't have more than one, just because they can really trigger some bad behaviors. Okay. So I usually say don't have more than one credit card. And again, no matter what the credit limit is, do not go over 30%. Okay. If it's a $200 limit versus a $1,000 limit, I don't want you going over the 30%. So let's say you did have a $200 card. 30% of that is $60. So you don't want to be putting more than $60 on that. Okay? So that's what we have to do. Okay? And that will help you build your credit. And you can use the same principles for building credit as cleaning up your credit. It's just you can see there's different things because when you're cleaning up your credit, there's things that you have to do before you just add new types of payments on there, right? If you have collections, you want to pay those off. If you have late payments, you want to focus on paying everything on time. So there's additional things that you have to do when you're cleaning up your credit. Okay, so here's the credit builder loan. So what the credit, this is why I love this so much, is the credit builder loan, it has a lower interest rate than you're going to find on credit cards, personal loans, things like that. Okay. And but it's like a savings account. I always say it's like a savings account on steroids. So I want you to think about having a piggy bank. Okay. And let's say you guys want to save $1,000 in the next 12 months. And so what's going to happen is that payment's going to be probably $84 a month. Some people like to round it up to $100 even. That's fine. But what you would do is you'd go ahead and you pay us. We put a large portion in your piggy bank, and then we put the smaller portion to us for interest. Okay? Each month we do this. After the 12th month, and you have the $1,000 in your piggy bank, what we do is we take a hammer, we crack open that piggy bank. We take that $1,000 that you gave to us as a payment, and we put that into your savings account. Okay? And the cool thing about this is not only are you saving money, it's a forced saving, so you can't get to it. You can't put the $100 in and then say, oh, how long I'm going to take it and I'm going to go spend it. No, you don't have access to it. But also, it reports on your credit report. So after a year of saving money, you now have $1,000 in your savings account, and you have it reporting on your credit report. So this is really helpful, especially for people who might not want credit cards, might have a hard time saving, because you can really choose the limit that you want when it comes to the credit builder loan and save however much you want per month. And so it's a great tool. We actually have some people that use this for, they're so cute, they use this for their Christmas savings. Because they don't have credit cards or anything. So they're like, well, I'm going to be putting money in the bank for Christmas anyway. Might as well have it reporting on my credit report. So people like to use that for that as well, which I think is cute. So they open it every year, same time every year, usually around October, because then the funds will be ready in October and be ready for spending for Christmas. But yeah, so that's how we get ourselves ready for purchasing a home, right? And getting that credit where we need it to be. You want to try and have, like I said, the best score possible. You want to make sure you can have the lowest rate you possibly can at the time you're buying your home. It's going to save you thousands and thousands and thousands of dollars, okay? And it might take a year, it might take 2. That's fine. I'd rather have you take 2 years now on getting yourself into a good spot, getting it where you need to be, and saving thousands of dollars rather than saying, you know what, jump in, go for it. And then all of a sudden you're spending $700 a month extra on a mortgage. So let's look at these. If we do in our example earlier, we said that between 7% and 11%, the mortgage jumped $700 a month. Okay, so let's look at if we paid $700 a month extra each year. So each year we're spending an extra $8,400. Now let's do that for the life of the loan for 30 years. By not working on your credit for the next 2 years, it could cost you $252,000. So that's why it's very important to get your credit in the best possible way you can. Work on it, get that score up. If you get it in the best you can get it, and get a better rate, it could save you hundreds of thousands of dollars. Okay? And that's why we love to put this education out there, because you typically wouldn't look at it that way, but now I bet you're like, holy crap, I'm gonna go look at this. I'm gonna get myself ready. So that's what we want from this education, is for you to be able to realize what the impact could be from doing it, but also from not doing it. Okay? So what's going to happen is we are going to send out a follow-up email with the recording for this presentation. And then also, if there was any questions that were asked through this presentation, we would get an email, and then there will be a second follow-up from us with the questions and the answers. Okay? And then that way, and if that will have all our information on those emails. But if you do want to reach out to us, if you accidentally delete the email, which I have done multiple times, here's our information, and you'll have that right in the video will come to you in that first email. But our email is centerfe@nhscu.org. And our phone with our direct extension is 603-224-7731, extension 330. And if you can't find the paper you wrote that on, you can always visit our website, okay? And our website has all our information on there as well. All right, guys, thank you again for joining me. I hope you got a lot out of this, and if you do have any questions, please feel free to reach out. Thank you so much, and have yourself a great day. Bye-bye.